A very good morning to everyone. Wishing everyone a happy Diwali in advance. We would like to welcome you to the Federal Bank press conference of Q2FY26 results. I would like to invite our senior management of the bank, Mr. KVS Manian, MD and CEO, Mr. Harsh Dukar, Executive Director, Mr. Venkat Raman V, Executive Director, Mr. Virat Diwarji, National Head Consumer Banking, and other senior members. Before I hand over the call to Mr. Venkatraman sir, I would like to request the members to share their questions either through the chat box or they can raise their hand if they wish to ask the questions. I would like to invite Mr. Venkatraman sir for the presentation.
Yeah. Manian, do you want to say a few lines before I start?
Just a few words of welcome. Thank you for joining us on this call. Good morning, everyone. I welcome you to our quarterly earnings meeting. And I'm glad to tell you that we have had a strong operational quarter with strong performances on multiple parameters, whether it was CASA, NIM, operating profit, fees, or asset quality. All of them have shown handsome performance through the quarter. I would leave it to Venkat to take you through the details of the performance, and then later we can do a question answer session where we could address your queries after you have heard Venkat. Venkat, all yours.
Thank you, Manian. Good morning, everyone. Thank you all for joining us to discuss our Q2 FY26 results. Before I jump into the details of the financial performance, a quick 1-minute summary of the macroeconomic overview in which we are operating. India's GDP growth forecast for this FY has been revised to 6.8% from 6.5%, signaling continued strength in the domestic demand and investment activity. The underlying tone of the economy remains positive. Inflation is easing, liquidity is comfortable, and the financial system remains stable. The ongoing GST 2.0 reforms are helping simplify compliance and boost consumption, especially for MSMEs and rural markets. Inflation remains well anchored, with the RBI revising its FY26 forecast down to 2.6%. A good monsoon, strong Kharif output, and healthy reservoir levels have all contributed to price stability. Externally, India's forex reserves remain strong at about $700 billion, and exports too are growing, up 5.2% in the April to August period. Of course, global uncertainty continues with trade tensions, the prolonged Russia-Ukraine conflict, and volatility in energy markets. FPI outflows so far this year have totaled about close to $4 billion, and the rupee has seen some volatility in line with global trends. But the big picture remains positive. India's fundamentals are solid, demand is steady, inflation is under control, and policy stability continues to anchor confidence. Now, moving on to the bank's financial performance, as briefly mentioned by Manian, I want to start by saying that it's another record strong performance from Federal Bank. We report record high NII and fee income. Net profit rises close to 11% QOQ. This is marked by all-time highs in both NII and fee income and consistent growth across core metrics. The key highlights for Q2 are NII 2,495 crore, reflecting stable margins. NIMs at 3.06%, which is an increase of 12 bips over the last quarter. We reported 2.94. For this quarter, we are reporting 3.06 as the NIMs. Our fee income, core fee income, is the highest ever in the history of the bank, 886 crore, underlying continued momentum in non-interest revenue streams. Importantly, the CASA ratio improved to 31.01%, up 94 bips. I repeat, 94 bips year on year. Our CASA deposits grew 10.7% YOY, to 89,591 crores. Our net profit rose 10.85% QOQ to 955.26 crore, driven by robust operating income and efficient productivity and cost management. Our ROA for this quarter is at 1.09 and ROE at 11.01%. And as I mentioned earlier, NIMs are at 3.06% for this quarter. Our deposits grew 7.36% YOY and advances at 6.23, whilst the overall growth numbers may look on the lower side, but the devil lies in the details. We have grown handsomely in the chosen mid-yielding segment, which I'll cover in a few minutes. Our asset quality remains amongst the best in class, with GNPA at 1.83% and NNPA at 0.48%. Our CRAR stood at a strong 15.71, ensuring comfortable capital position. And our provision coverage ratio remains robust at 73.5%. The total business of the bank reached 5,33,576.64 crores, registering a growth of close to 7% YOY. On the advances side, we had a growth YOY of about 6.2%, but more importantly, customer advances QOQ grew 2%. Deposits have grown 7.36% from 2,69,000 crore to about 2,89,000 crore as at 30th September. The other important metric on operating performance, we have grown handsomely to 1,644 crores in this quarter, which is a very strong performance as compared to the previous quarter as well. And all of this, despite the fact that we have a 100 bips rate cut impact, which has been baked in. Our net interest income grew 5.4% YOY from 2,367 crore to 2,495 crore. Total income for the bank for the quarter grew by 3.75% YOY to reach 7,824 crore, with an EPS of 15 rupee and 42 paise. Asset quality, as I mentioned earlier, is quite resilient. Our GNPA is at 4,532 crore, which has a percentage, which I said is 1.83%. Net worth of the bank increased 12% YOY, and it now stands at 34,819 as on 30th September, with a CRAR of 15.71%. In terms of footprint, the number of banking outlets are at 1,595, with our ATM recyclers at 2,082, including mobile ATMs. So these are the key highlights, and I want to leave enough time for Q&A. So let's get into the Q&A session, and the whole team are here. We are happy to take your questions.
Thank you, sir. Thank you. Before we go live again for Q&A, I would request all the team members again, either put your questions in the chat box or raise your questions. We'll answer it one by one. I would like to first go with the chat, which was added by Anupriksha Jain from Financial Express. So the first question is, how are GST rate cuts playing out?
So let me take that. Of course, it's early days. It's a few days since those cuts happened. But our expectation is that it will boost demand, and as long as the supply side can keep pace, I think we do expect GST rate cuts to boost demand going forward. But this will play out over this quarter, I would feel. Early days just now.
Sure, sir. So the next question by Anupriksha is, how are you seeing H2 as RBI relaxes several norms to boost credit growth?
So, Anupriksha, two parts to this. One is the corporate credit growth, and one is the retail credit growth. On the corporate credit growth, as you have seen the numbers last reported, it's in low single digits as of now, the growth. So one is, corporates are also going to the bond markets to raise money, or equity markets also to raise money. And therefore, the corporate credit demand has been muted. So however, I do expect the retail side to the credit growth to improve if the demand driven by GST rate cuts also picks up. I do expect it to pick up. So over the next 6 months, I see a mixed bag in terms of corporate still uncertain on the growth side, but retail probably will continue to drive credit growth for banks.
Sure. Thank you, sir. Anupreksha, if you have any follow-up questions, please do write on the chat, or you're open to answer questions following them. The next person we would like to go with Shrishti Sharma. She's from ETBFSI. Shrishti, over to you.
Thanks, Archana. Good afternoon, management. My question is on margins. A lot of banks still have seen decline in their margins. That's not the case for Federal Bank. So it is at 2.94 right now, which is an improvement from the previous quarter. What has aided the margins improvement for Federal Bank, and have you rebalanced the book in the past 6 months since the rate cut has been happening in terms of EBLR and MCLR? Has the composition for Federal Bank in terms of EBLR and MCLR changed so far? So yeah, what's aided the margins and the composition of the book?
Yeah. Just before we respond to that, just want to correct your statement. 2.94 was Q1 NIM, and Q2 is 3.06. So Q2 we had a 12 bips increase in NIMs.
Right.
Yeah. Yeah. In terms of the key drivers for the improvement in margins, of course, our deposit cost fell greater than the drop in the yield on advances. That was one big contributor. Second one was the cost of borrowings was down for us, QOQ. And thirdly, there was some impact from CRR and other asset optimization. So a combination of all this helped us deliver this 12 bips increase. It's all largely operational performance. There is no one-off in this.
And in terms of the composition of the EBLR and MCLR book, has that changed for you?
Yeah, it used to be a few quarters back. Last year, same time was around 53%. It's down to now around 48%. So that is coming down, and that's a repo linked book, and we are seeing an increase in the fixed rate book, and that is also helping us. And secondly, you should, like I said earlier, the pivot towards medium yielding segments and growing those faster is also helping us in terms of getting better margins. So it's not just chasing growth for the sake of growth, but profitable growth.
Sir, I've noted the EBLR repo link book. Could you also quantify the MCLR for us?
MCLR, I'll just give it to you in a minute. Just give me a clue.
Sure. Thank you.
Yeah.
So we would meanwhile go to the next question, if that's fine. The next question is from Hamsini Karthik from Money Control.
Hi, good morning. Couple of things I have as queries, but like last time, I have another request this time as well. Although Saturday is not getting moved, if you can help us with an investor deck along with results, that would allow us to frame questions in a more sharper manner. Your provisioning cost has gone up, whereas gross and net NPA as a percentage is reduced. Is the bank taking provisions in anticipation of ECL rollouts, which is set to begin from next year? I'd like to understand why provisioning was around in the ballpark of 36,000 crore this quarter.
36,000 crore. I don't know where you're seeing what number.
I'm sorry. I'll just give you the right number. 3,000. You put your numbers in crore. Lakhs.
Look at the credit cost. You can look at the credit cost.
Yeah, no. Provisioning is a little higher on a YOY basis. So I'd like to understand whether you're beginning to make Prudential provisioning in anticipation of ECL as well. We saw one of the largest private banks show an increase or a slight uptick in NPA numbers. Their commentary was sort of seeming to suggest stress, whereas Federal Bank's asset quality seems to be slightly better in comparison. I'd like to understand a little more on asset quality.
Sure. Let me try and give you a response, and then Manian, if you can come in.
Yeah.
There are 2-3 things to this. In terms of asset quality, slippages, Hamsini, this quarter is lower than last quarter. Like we had guided as well, we have seen the traction of MFI slippages also going down on an absolute number from 658 crore, it has come down to 579 crore. Credit cost is also down from 64 bips to around 50 bips for this quarter. Third thing, you are comparing last year, this quarter to the current period. Please note that we started the accelerated provisioning from Q3 of last FY. So it's not a right comparison to compare last year's provisioning with this year's provisioning, because this year, due to the change in and having brought in accelerated provisioning, you will see that impact coming through. So not a like-for-like comparison.
Okay, sir.
And our asset quality, as you rightly said, is definitely good, and we are seeing improvement as well in the asset quality.
Yeah, in fact, Hamsini, if you go back to our credit cost, and if we take the MFI credit cost aside, our credit cost is almost steady at where it was 1 year back, and we have seen no deterioration in credit quality in any other asset class overall in all other asset classes put together, compared other than in MFI, which we had called out last quarter as well, and that remains the reason this quarter as well.
Perfect, sir. We also saw the RBI relax on the single borrower exposure limits, and open up acquisition finance as a line of business for banks. You have a fabulous corporate banking team. You yourself are a veteran corporate banker. How would you want to position Federal Bank to take advantages of some of these incremental changes that have happened?
I'll ask Harsh to respond in detail. Harsh, you want to go? I can come in.
Yes. Okay. There are a couple of points. The draft guidelines have been issued. What they have said is that acquisition financing, which was actually not allowed as capital market exposure, we are seeing relaxations over there. So these borrowings, which were earlier going through NBFCs, private credits, or AIFs, increasingly bank finance will come to it. So these will be more structured credits within the banking system once the guidelines come out clearly. But we clearly see this as an uptick. So that is one positive sign for us. And given the relationships we already have built in, I'm sure we will be able to leverage out. So in fact, we have started reaching out to corporate customers also in terms of how to assess this and take it forward. The second part is your large exposure framework, which has been shelved. Earlier, it made it mandatory for the large corporates to go to the capital markets, which has now been removed. And hence, a little part of that flow which was going to the debt capital market can come back to the banking system. So both technically are going to be positive for the corporate banking and the wholesale banking system.
Okay. Lastly, on capital, on your capital raising plans, sir, are you looking at a preferential issue or a QIB or something like that in the immediate annual?
Hamsini, we have just sent out a stock exchange notification that our board will meet on 24th to make some decisions on this. So we will await that board decision before we engage further on this topic.
Yeah, thank you so much, sir.
Yeah.
That sort of answers all my questions. Thank you.
Thank you, Hamsini. We'll go over to Ritu Singh from CNBC. Ritu, over to you. Ritu?
Yes. Mr. Manian, I just wanted to understand, on the fundraising front, are you looking at a strategic investment or, any clarity you could give us?
Ritu, as I said,
that
our board is meeting on 24th. We've just sent out that stock exchange notification. So let's wait for the 24th to hear more on that subject.
Sure. That is with regards to fundraising. What I wanted to understand is if you're looking at a strategic investor in any sort of broad guidance you could give us on that front. And secondly,
Ritu, before the board meeting, I can't give a guidance. I let the board make a decision and then we will come back. Please allow us that time to come back to you on that.
Sure. The second thing, Mr. Manian, was on your corporate credit growth. I mean, Harsh just spoke about how some of these relaxations, of course, are positive for the bank, whether that is the large exposure framework or the acquisition financing. But any specific guidance you could give us in terms of when you see a recovery or a pickup in this segment?
So, Ritu, there are two large segments on our corporate side which we chase. One is, of course, the large corporates, and one is what we call the mid-sized corporates, right? So, it is our desire to build both these segments, and particularly the mid-sized segment is a focus that we want to keep. And of course, that takes time to build, but that is clearly one of our focus areas. As of course, we continue to work with larger corporates to see what opportunities which Harsh talked about. So, but overall, Ritu, this will change only if the credit pickup happens on the corporate sector. Credit pickup in general happens, which you have seen the numbers. As of now, they look still weak. We are hoping that as demand picks up and GST drives demand, hopefully capacity buildup in corporates will happen over the next few quarters. We are hoping that there will be some automatic traction on the corporate credit side, which we are quite well placed to capture if it were to happen.
All right. Thanks so much.
Thank you.
Thank you. So to the next person, we have Harsh from ET Now. Harsh, over to you.
Hi, thank you for the opportunity. I wanted to understand structurally, how do you look at growth now? It seems the book is far more stabler, slippages are improving, asset quality is improving. So is it time to push the growth pedal in a faster fashion? How should one look at growth?
Yes. So, if you look at this, essentially, there are several segments where we are already pushing for growth. One, of course, Venkat mentioned the medium yield segment, where we are already pushing for growth. Medium yield segment, our commercial bank, commercial vehicle kind of assets are already growing fast. Retail gold loans are growing fast. So we are already in areas where we have chosen to grow. We are already able to grow. There are a couple of more. Cards is another area where we are growing fast. So there are areas where we have chosen to grow fast. We are already growing fast. There are a couple of areas we have chosen to grow, and we are hoping that the second half we will grow better. Areas like LAP and small businesses, BUB business segment. So we think in the medium, these all are part of our medium yielding. Card is, of course, higher yielding segment, and we continue to want to grow these at a fast pace. On corporate, like we mentioned, of course, we want to grow, but grow the medium size corporate segment also faster than the large corporate, of course, subject to corporate demand picking up. The two areas where we want to remain slightly more cautious are the MFI and the personal loans area, where we are continuing to remain cautious and not pushing for growth. So broadly, from a mindset point of view, we are clear that we need to grow in our chosen segments, and the growth must be profitable. These are very important for us. And we are seeing opportunities to grow at a reasonable clip and still remain profitable. As you can see, our commercial bank is growing at very healthy pace. Commercial vehicles has been growing at a very healthy pace. Cards has been growing at very healthy pace. So we will continue to pick segments where we can grow faster and grow profitably.
No, the point taken. And Mr. Manian, I wonder how should one view margins therefore? You've mentioned a couple of times now that the tilt is going to be towards medium yield.
Yes.
Does that mean that your across cycle margins will be far better than what have been the case traditionally? And
Yes.
what
So
would that broad level number be? Give us a sense.
Yes. So as you rightly said, I think we are trying a structural change in our NIM structure, NIM, right? The asset side as well as liability side. On the liability side, as you have noticed, we are pushing for higher CA and higher CASA. In fact, our performance on CASA has been quite good. On CA, of course, the growth has been good. SA, the growth has been good. Average growth has been even better than what the end of period numbers show. We have gained market share in non-resident savings market. Our non-resident remittance market share has gone up back to 21% in terms of inward remittances, inward personal remittances. So I think we are trying to make a structural difference to the NIM over a period of time. It's a work in progress, but we will continuously aim at improving NIMs. The structural
Sorry, sir, for
improvement over a
pushing.
period of time will need to improvement in NIMs.
Sorry, sir, for pushing, but is there a number broadly, internally? Is there an aspiration?
I leave that to Venkat to give, on my CFO to give me that guidance.
Harsh, this is also dependent on factors like we don't know. There is an expectation of another rate cut. So there are a lot of moving parts. So I wouldn't venture to give a number per se, but like Manian said, we are working directionally. It's all in the improving profitability and NIMs, both on the assets and liability side. Mind you, it's not just the asset side. NIMs improvement is also coming largely from our improvement in CASA, average CASA. So yeah, all those are the focus areas.
Sure, I'll leave the floor back. And many congratulations. Very, very steady quarter from Federal. So congratulations to the entire team for that.
Thank you.
Thank you.
Thank you.
Thank you, Harsh. We'll take question from Kumud Das. He's from Hans India. Kumud, so over to you.
Yeah, am I audible?
Yes.
Good afternoon, sir, and congratulations for the good, financial results in the quarter. And I just wanted to understand on a broader perspective, sir. The RBI has announced redemption of SGB 2017-18 Series 3 with an issue price of 2,866 per gram. So it has grown. The gold prices have gone up by 450% during past decade. So how do you see going forward? You said that gold loan has picked up. I just wanted to understand from you. So how do things look forward?
Harsh, you want to take that?
Yes. Okay, I'll cover this part in a couple of different heads. One is in June, the Reserve Bank had issued guidelines for gold loans and unified approach for all lenders. It consolidated all circulars and gave clarity, which I think is becoming and has given some relaxations as well in terms of to encourage the small borrowers or for income generating one. So we think that because of these reasons, there is a regulatory environment which is more conducive for the growth. The second part, if you look at it, the gold prices, as you rightly mentioned, has gone up, and more particularly in the last 1 year. And that has given us even more headroom when they renew gold loans to get a higher loan amount. So while the tonnage may not increase to the same rate, I'm saying other things being equal, you can still see an uptick in the gold loan. The third part is, in general, there's been more awareness amongst the borrowers, more so who have not been exposed to formal credit, to come to this segment at rates which are far lower than what they were to borrow from friends, family, or unorganized sector. So between these three things, we are quite optimistic and bullish on our gold loan portfolio growth. We have been running down one of our wholesale piece of the gold loan portfolio, which as per the regulations is permitted not beyond this year. But if you net it off, we have seen an almost a 7% QOQ growth in gold in this quarter itself.
Okay, my second question. Hello.
Yes.
So my second question is on retail inflation. So it has gone 98 or 99 months low. So do you think that it provides enough headroom for RBI to go for next round of rate cut in December? And how much?
So, Kumar, the way, of course, everybody expects the retail inflation to bounce back in the last quarter. It is not likely to remain there. I think the expectations are that it might bounce back to about 3%. So one has to wait and see the data as it gets printed. Of course, the general view of the market is that there could be a drop in the rate. But let's see how the data plays out. I think the demand data, the inflation data, how it plays out over the next few months is critical.
Okay, thank you, sir.
Yeah.
Thank you, sir. Now I'd like to go with a few questions from the chat. We have question from Ashish Agashe from PTI. His first question is, what were the gross slippage in Q2?
Yeah, I think I mentioned it earlier. Gross slippages was 579 crore. It's an absolute number, but lower than last quarter, 658 crores.
And at 0.94%.
Yeah, it's still continues to be below that 1%, which we 1% of assets, so it's 0.94%.
Sure. The next question is, what has led to an increase in provisions on year?
Now, again, like I explained to Hamsini, it's not correct to compare last quarter FY, second quarter with this quarter, this FI, because from Q3 we had the accelerated provisioning. So I would request.
We changed our provisioning norms for unsecured loans in the third quarter of last year.
We changed it. Yeah.
Therefore, the last year second quarter and the current year second quarter are not comparable in terms of provisions.
Sure. The third question that Ashish has is, has there been any revision in the FY26 credit growth target, and what is the outlook on NIMS?
Yeah, on credit growth, like it was mentioned earlier by Manian as well, we normally try to benchmark ourselves against the nominal GDP, and we expect to grow around 1.2x of that. Currently, nominal GDP with the low inflation is, of course, at single digits. So I would say between 10 to 12% would be the credit growth for H2.
Sure. That's the questions from Ashish. I'll move to the next question on chat. Sanal from New Indian Express, she has two questions. What is your share in deposits from non-residents and personal remittance?
Virat.
So we don't disclose our NRI market share, I think, but I did talk about the remittance share having touched 21% back. So on personal remittances, our share has gone up from 18.5 back to 21%.
But overall, in fact, the NR means market share there also we are gaining.
Gained market share in the last.
Yeah.
Sure, sir. The next question that Sanal has is, what led to the profit in Q2?
He said earlier, right? There's a combination of several things which has fallen in place, and obviously these are all in line with what we had outlined as our focus areas. The sharpening in terms of profitability of medium yielding, better fee income across lines, lower credit cost to income going down. It's across lines. It's not just one item which has contributed, but again, very strong performance in Q2.
I think can we take the last question from Vishwanath Nair is raised his hand. Can we take that question and then close the call?
Hi, Mr. Manian.
Hi.
I just wanted to ask you about the advances growth. I'm not sure if the question has been answered. I was in and out of this call. But the advances growth at just a little over 6%.
Yes.
I'm trying to understand because you're constantly talking about the push for that medium return sort of business.
Yeah.
At what point in time will that show up in the advances growth picture? And secondly, on the corporate slippages, I just wanted to get some color of what happened there.
So, Vishwanath, as I said, if you look at the numbers granularly, all the many of the mid-yield segment we are growing fast enough. It is just that the home loan segment is showing a -1% in the quarter, and therefore and you must remember that almost 50% of our book is between corporate and home loan business, and so we have to grow the other business fast enough to make up for the lack of growth in these two, because these we are choosing one. In home loan, we are choosing to be, I think the rate dynamics in that market are not favorable enough for us to push hard on that. And therefore, we are, while we want our customers to be served, so we don't want to aggressively push for growth in those low yielding segments like home loan and corporate. Corporate, as I said, we'll again be choosy about what we do. So therefore, you must look at the book growth in the context of the fact that 50% of our book is in the low yield segments. And in fact, our medium yield segment is, several parts of our medium yielding segments are growing handsomely already. And we will continue to improve the trajectory on that. And your second
Corporate
question.
slippages, sir. Corporate
slippages hasn't been significant. There is a single account, a small slippage we have seen there, but nothing significant at all. I mean, the book is continues to hold very good.
So that provision impact is largely coming from that one account. Is that it?
What the provision?
Your provision has gone up.
Again, as we said, please do not compare this quarter provision with YOY last September, because they are not like to like. Last September, we were not following accelerated provisioning norm on our unsecured book. So whereas we started doing that from third quarter of last year. So to that extent, they are not comparable. So actually, if you look at credit cost point of view, other than on MFI, our credit cost has remained absolutely stable all through the last 1 year.
Yeah. Sorry, the only reason I brought that up is because apart from that, there's nothing else hurting your profit growth. So that's the only reason.
Like I said, that is not a right comparison. As you will see, it will ease out from fourth quarter. Of course, next third quarter, we took a higher provisioning last year. So from fourth quarter, it will normalize, and then YOY will be really comparable after that.
Got it, Mr. Manan. Thank you so much.
Thank you. Thank you everyone for joining us on this call.
Sir, I have a last question, if you can take it. I'm so sorry I'm troubling you.
Yes, tell me.
I'd like to understand the movement on yield on advances. There's a 49 basis point decline if I look at it on a YOY basis, 935 to 886.
Right.
What is hurting yield, and where you expect yield to normalize?
No, so Hamsini, 100 basis drop in repo rate, and about 50% of our assets were sitting, as Venkat said, 53% of our assets were sitting at that time in the repo rate. So, 100 basis cut is a straight 53 drop. Actually, 48, 49 is an improvement over that 53. So that is a natural consequence of repo rate connected book, right? So that would have happened for most banks. That would be, I mean, of course, banks will differ from the percentage of their book in repo rate, but all will be in the 40 to 50 to 60, 55 range, right? So that is a...
So this is all just repo linked. It's nothing.
Large part of it. In fact, we have been able to defend some part of the drop actually. And of course, corresponding drop in deposit rates and cost of funds has happened over this period to defend it. Yeah.
Thank you, sir. Thank you.
Thank you.
Thank you all. Thanks.
Thank you all. Thank you very much again for joining us today.
Bye. Thank you.
Grateful.
Thank you.
Thank you.
Thank you.